So while pre-shipment finance prepares the goods, it is post-shipment stage where the actual realization of foreign exchange occurs. From bill discounting and negotiation to the complexities of bill crystallization and risk mitigation, mastering these aspects is essential to ensuring that our bank's trade portfolio remains healthy and compliant with FEMA and RBI guidelines.
So, what are the some of the features, important features of the post-shipment finance are? It is extended, as I said, after the shipment of goods or the rendering of service. It is extended on the evidence of shipment of goods. It is because against the debtors or receivables, it is given mostly as a against bills. It is nothing but a bill finance. The period generally is about maximum 180 days. It is concessional rate is also restricted to 180 days. It may be sometimes export bill proceeds or duty drawback payment relating to the exports. We have to look into it. First one is we have already predominantly bill finance. So like any other bill finance, it is secured and self-liquidating. However, the loan given against the duty drawback or undrawn balances, they are unsecured loans. Before going into the different types of the post-shipment finance, let us understand certain rules of FEDAI on export transactions so that we can understand those aspects when we are discussing the types of finance, the terms we can easily understand. So what is the rate of exchange will be applied by the authorized dealer whenever they take up the purchasing, discounting or negotiating an export bill in foreign currency. It is the bill purchase rate. So whatever the current bill purchase rate is there, it will be applied by the authorized dealers and they will recover simultaneously interest for non-normal transit period in case of demand bills 450 days, but the concessional rate of interest will be up to 180 days. So in case of demand bills, we said the post-shipment finance at concession rate can be given for NTP. Discount, the period of finance at concession rate of interest will be up to notional due date, when due date cannot be ascertained, subject to maximum of 180 days. So notional due date is arrived. So this normal transit period and notional due dates are linked to the interest rate on export bills to arrive at the due date of the bill or export credit, which we have seen in the previous slide. We have to look into the normal transit period given by FEDAI for different categories of export business. Suppose a fixed due date is there. In case of the export usance bills, where due dates are fixed or reckoned from the date of shipment or date of bill of exchange, etc., the actual due date is certain and it is known. So in such cases, normal transit period separately is not applicable, which was given in the but the authorized dealer may apply transit period that varies from above NTP for exceptional situations based upon the historical data for specific exporter or overseas buyer. Authorized dealer bank should be responsible to demonstrate the document relying upon which the facility of post-shipment export finance was provided. So after say 10 days, so 10 days plus 5 days, so this will be the 15 days. So this additional certain number of days from the date of negotiation period should be added. Even the slightest deviation from the terms and conditions specified in the letter of credit can give an excuse to the issuing bank to refuse the reimbursement to the negotiating bank. Generally, there are certain common discrepancies being observed in this type of letters of credit. Then what are they? Sometimes late negotiation of documents, that is submission of documents after the expiry of the letter of credit, late shipment of goods for exports, that is Bill of lading is later than the data given in the LC. Late presentation of documents, they are supposed to be presented within the 21 days, or the incomplete or incorrect drawing of draft or bill of exchange, insufficient number of copies of various documents as required in the letter of credit, non-submission of the document. By giving the uniform numbering system, because now all are computerized, our system module may be there specifically for export bill purchased or discounted. We have to enter and it will generate the uniform serial numbering system. General ledger head, like demand bills purchased in foreign account or usance bill discounted foreign account, as per our internal procedure, and give the credit to the exporter by converting the amount into Indian rupees. Here we have to apply the bill buying rate, which is the same with the same amount at the time of purchase and eliminates the entry created for the purchase of the bill. This is generally practically what we will do at the branch. In those circumstances, we can sanction the post-shipment advance against export bills sent on collection. So in case of advance against export bills on collection, the concessive rate of interest will be charged for the normal transit period sent on consignment basis. It means exporter sends the goods abroad to his agent or consignee with the condition that the agent would remit the sale proceeds after the sale of goods. So the bank, while forwarding the export documents, instructs its overseas correspondent to deliver the documents against receipt and undertaking to deliver the sale proceeds by a specified date. Pre-shipment account and we will close, and the balance, outstanding balance in the special post-shipment account will get adjusted as soon as the relative proceeds are received from abroad. RBI's foreign exchange department has permitted on case-to-case basis longer period than 12 months from the date of shipment for realization of the proceeds. So for them also it is possible, and also 100% export oriented units and also units set up under EHTP, STP and biotechnological power schemes, which we have seen in the first session. What are they? Consignments exports are treated at par with cash exports, as we discussed in the earlier slide. So maximum period 180 days, it is eligible for the concessional rates, not transferred. Now it has to be transferred because if it is not transferred, it will not be it will go along with the other export finance and we may wrongly claim the refinements. Say 10 millions, say 10 millions. But invoice will not be raised for 10 millions. It will be raised to up to 9 millions or 9.5 millions or 9.8 millions of the FOB value. The importer or the buyer in the other country, after the receipts of the goods, he verifies the weight, quantity, quality through inspection and analysis of the goods. The quantity, quality and weight and then make the difference of payment. In such cases, this undrawn balance will arise and authorized dealers can provide post-shipment credit against such undrawn balances. In general, bill financing, post-shipment credit, we give 100%, but here against the undrawn balances, a margin of about 10 to 15% can be kept as the margin so that it due date in case of usance bill. So advance should, the concession rate is applicable, concession rate is applicable only for a maximum period of 90 days. Then post-shipment advance against deemed exports. We discussed what are the deemed exports in the first session. That is nothing but developmental banks, IDA, IBRD, wherever they have such supplier for a maximum period of 90 days or up to the actual date of receipt of payment, whichever is earlier, that post-shipment credit also can be provided. Or any, mostly customs authority in case of custom duty or other authorities in case of other duties. This form indicates the provision duty drawback entitlement. Through this form, when the exporter is submitting, he will authorize the financing bank to receive the amount from customs authorities directly as his agent. Advance at generally duty drawback will be given at most of the time at post-shipment stage, but sometimes it is also will be given at a pre-shipment stage, uh, domestic price, and the difference is only because of the duty drawback. So it can also be sanctioned a pre-shipment credit, and it should be covered under export production finance guarantee of ECGC. Post-shipment on deferred payment terms. Banks are permitted to grant post-shipment credit on deferred payment terms for a period of exceeding 12 months in respect of export of capital and producer goods as specified by RBI's Foreign Exchange Department from time to time. Either under negotiation or purchase discount in these categories, the major portion of post-shipment credit will be under those heads. All other heads are very minor amounts. The prescribed interest can be applied only up to the actual due date, irrespective of whatever may be the notional due date we arrive. These are the rules. Then, what is the interest? The excess interest, if they are received earlier to these dates, the excess interest collected for the period from the date of realization to the last date of NTP, conditions at the country level, that is non-exportation of foreign exchange by the government or central banking authorities of those countries concerned, whether ECGC gives 90%, 75%, and the 25 and 10% is bringing by the customer, the exporter, and closing the account, we have to charge this interest export credit, not otherwise specified rate of interest for the full amount. Excess amount charged to the customer, that is difference between the quantum of interest already charged and the applicable interest, concessional interest, taking into consideration the realization of realization of the exports in the foreign currency. Okay, while negotiating export bill drawn under letter of credit, which provides for the reimbursement, then how many days the bank should recover the interest? Our actual date, we have already discussed it. We have to refund the interest, and the date of receipt has to be treated that the date of debit to the Vostro account of the foreign bank with a bank in India, interest recovered for the period from the date of realization to the date up to which interest is already collected. So the difference amount has to be. Then coming to the post-shipment export finance in foreign currency. Overseas facility we can have. Then banks may arrange a bankers acceptance facility where export bills are accepted without any margin and risk is covered by collateralized documents. Each bank have its own bankers acceptance facility fixed with overseas bank or risk discounting agency or an arrangement with other agencies such as factoring agency. So exporters on their own can also arrange for themselves a line of credit with an overseas bank or any other agency for discounting their export bills direct, subject to the certain conditions. So under this scheme, if the limits granted to banks by overseas banks and discounting agencies will not be taken into consideration for the purpose of borrowing limits fixed by the RBI's. So eligible criteria is the scheme covers mainly export bills where usance period is only up to 180 days from the date of shipment, including normal transit period and grace period. For overseas institution is ready to accept it. In case of borrower is eligible to draw usance bills for period exceeding 180 days as per the extent instructions of FEDAI or by way of foreign exchange loans to the exporters out of foreign currency balances available with the banks. That is, we have discussed FCNR, FCNR or RFC account balances and this that, or also EEFC. It is possible that the banks hold bills in their own portfolio. And sometimes different banks will have different bankers accepting facility. Some banks may be having the balance with them. Some might have exhausted their balance. The banks which are having the balance can, under this scheme, as such, it has to be maintained separately so that we will not go wrong in claiming the refinance against the export credit finance. Interest rate structure on export credit in foreign currency, the interest rate applicable to under this type of post-shipment credit is as subject to guidelines from RBI from time to time, depending upon the market conditions, and they are in related to benchmark rates. So this is with regard to the post-shipment finance. But having done the post-shipment, there may be possibility of non-payment and crystallization. So what is crystallization of a liability and what are FEDAI rules says that either as per the expiry of normal transfer period or a usance period, notional due date. If it is not paid on 30th day, it has to get converted from foreign currency to rupee liability. The TT selling rate ruling on the date of crystallization or original bill buying rate, whichever is higher, should be utilized to decide the crystallization amount. Interest recovery. On the date of crystallization, the authorized dealer should recover interest for the period from the date of expiry of normal transfer period or notional due date at appropriate rate for overdue export bills. The export bills payable in countries with externalization issues shall also be crystallized as per the policy of the authorized dealer, notwithstanding the receipt of advice of payment in local currency. Swap cost and swap gains. When the bill is not paid on the due date, the authorized dealer has to buy the foreign currency in the spot market to honor its commitment and has to take cover again in forward market, which is a swap transaction. So whatever the cost they incur, when the bill is realized and the advice is received, the authorized dealer will purchase the realized foreign currency amount by applying the TT buying rate of exchange, borrower or customer if it is positive. If it is a short less, it will be recovered from the customer. The authorized dealer to recover the interest for the period from the date of crystallization to realization of bills at the rates applicable to overdue export bills. Again, forward spot market to meet the forward sale transaction entered with the market, or again entering into the forward purchase for the bill. It, as I said in the earlier slide, it is a swap. So it involves the swap cost to the bank and extension of due date, where the due date of an export bill is extended with the prior approval of RBI. Crystallization has to be done if the bill remains unpaid on the 30th day of from the revised date. If an export bill negotiated by the authorized dealer rejected by the LC opening bank abroad, what to do? How to recover the amount? Recover the amount from customer by applying the ready TT selling rate ruling on the date of refund. When this scheme was introduced, prior permission of RBI was required to open the account. Now, as of August 25, these banks can open these accounts directly for existing correspondent partners without prior RBI approval. And the exporters, importers will agree to raise the invoice in rupees. The exchange rate between Indian rupee and the partner country currency is market determined. Then, while settling or making the payment, importer in India pays rupees into Indian bank, which credits to the foreign bank's special Vostro account. Exporter receives the payment in rupees from the balance in the foreigner's partner's Vostro account. Usual documentation wherever we are taking from the exporters and importers. Letter of credit and other trade-related documentation may be decided mutually between banks of the partner trading countries. Documentary credit and Incoterms and exchange of messages in safe, secure, and different way may be agreed, efficient way may be agreed mutually between the banks and partner countries. For the commercial banks, important things it provides is advisory services, because to the exporters also it provides and foreign countries also. So current commercial banks can use its advisory services besides the refinance for this is a statutory authority was created by the government of India to regulate these financial service centers. Presently, it is a gift city in Gujarat, and in this gift city only it is headquartered. There are so many regulators like RBI, SEBI, IRDAI, PFRDA, all these things. Under this IFSCA Act, these regulatory powers were vested with IFSCA for matters related to internet financial centers, service centers, setting regulatory framework covering the capital market, banking operation, insurance, pension funds, ensuring investor protection and financial stability, positioning the GIFT IFSC as a globally competitive financial hub, attracting the financial capital, and fostering innovation in financial product and services. Indian banks or Indian insurance companies, they might have to take any approval from their regular regulators, but the main regulator for this area is a IFCA. Depending upon their track record, these gold card holders will be granted better terms of credit, such as finer interest rates than those extended to other exporters. In principle, limits will be sanctioned for a period of 3 years with a provision for automatic renewal subject to fulfillment of terms and conditions of sanction. A standby letter of credit and standby limit of 20% of the assessed limit may be given additionally. The facility for further value addition to their cards through supplementary services, any technology services, it is being given to all nowadays. The rate of interest charged to the gold card holders will not be more than the general rate for the export credit in the respective bank and within the ceiling prescribed by RBI. Green card holders, on the basis of their track record of timely realization of export bills, will be considered for issuance of foreign currency credit cards for meeting their urgent payment. Banks may also consider granting term loans in foreign currency in deserving cases out of their FCNRB, RFC, etc. funds. So friends, this is what I wanted to present in post-shipment.
For that exhaustive breakdown of post-shipment facilities, you have provided a very clear roadmap on how to handle bill crystallization and vital role of Exim banks in supporting long-term trade.
Initially, and we have added many other features there for the credit due diligence. So one is, I will suggest that the credit due diligence part should be taken very seriously. One part of it. Second part of it, Fareed sir, you will agree with me, can be done. That is what is my suggestion. Fareed sir, I had sent you a message. I mean standby letter of guarantee, not credit. Standby letter of guarantee, where the multiple exports are done under one single guarantee letter. And the payment is expected to come. If not, you may invoke the guarantee. So that standby letter of guarantee product which is there, that also has to be understood by my bankers rightly and try to exercise all the cautions. The last, before I close, you are aware that there are maybe more than 10 to 15 export promotion councils for each product or each activity. And they have a lot of information on their activities, on their what's called the members. So I will do a due diligence on my prospective customer that yes, this person is doing a good export. This person has got a good reputation. His standing is good, because even the export promotion councils, they give the awards and all that based on the.
There is a question in the chat box also. But before I take up that question, I just wanted to remind the people to give the feedback also. Members, club members, they are giving feedback.
Issuance bills. But this normal transit period it was a period normally involved from the date of negotiation to bills receipt of the bills. So in case of demand bills, the documents will be released only after the payment. The proceeds, all these things should happen within 25 days. That is called the normal transit period. It is expected that after negotiation of bills reaching them verifying and all those things. So this is called the period to be taken by the importer's bank or importer to verify and pay back the Ison's 90 days will be given, and this average period also will be added. Sometimes there will be 3 days, 5 days, 2 days grace period will be there. So to arrive the NTP, that due date, this NTP will be added, Ison's period will be added. If there is a grace period is there, that will be also added. But in some of the cases,
Thank you. I hope Mr. Nand Kumar Jha, he is further asking for a thing. Sir, is this negotiation of bill starts when the final bill is received by importer? Is it so? And Mr. Nand Kumar Jha's question is completely answered. And now we have another question, sir, from Mr. Santosh Kumar Jaina. He is attending our webinar for first time only.
Star house exporters are automatically, because of that classification, they are getting all the benefits of gold card scheme or much more benefits also.
Sir, here advance against duty drawback, we are considering it mostly as a post-shipment facility. But since there is no shipment involved, why can't we treat it as a pre-shipment? Why can't we extend as a pre-shipment facility? Okay. My second question, sir. Generally, while assessing the post-shipment credit limit, we will assess basing on the debtor holding level, the estimated levels. That means projection or estimated levels. Sometimes the firms or the companies seek more credit period than their estimations, stating that we will be offering a higher credit period, we will be entering newer markets, and sometimes the bills are not realized as per the projections. So in that case, can we be flexible in that approach, or else we should be strictly limited to the estimated holding level or projected holding level?
Different issuance period. Sometimes it is suppose you have taken 3 months and you have calculated the limit, what is required by a exporter, but sometimes it may be only 2 months. So then second one is when the average of his inventory or the issuance period is increasing from 3 months to 4 months. Next time when you are renewing, you should consider the 4 months issuance period and revise the limits accordingly. Even in domestic CC limit also, though you are taking an inventory holding period of 10 weeks or 15 weeks, but actually when you take the stock statement and update the DP and all those things, if it is less than the loan outstanding foreign exchange proceeds are getting, then you are adjusting from the rupee sources. Whenever you are adjusting from the rupee sources, you have to charge the interest for.
And he was traveling also during this period, but he has taken these sessions. And of course, to our mentors, thanks Saleh sir for his useful insights, and participants for making this session a very dynamic learning environment by asking their questions. And for all members or registrants, your learning resources, including the full video recording of both parts, technical summaries, and the specialized ebook, will be uploaded to our app, Elite Bankers Club app.
No, I mean you can always say that with the new EU FTA, the new initiatives on the export promotion, there will be a lot of business opportunities, and thus banks have to really prepare themselves very well for these opportunities.
Yes. As our guest attendees, we hope this experience has demonstrated the value of our community to you. And by joining as a regular member, you can save up to 50% on future session costs and join an elite network if you take the membership. And thank you for your time and dedication for this professional excellence. And we look forward to seeing you at our next session on the analysis of Union Budget 2026